joining us now, Bilal Hafeez, Macro Hive CEO and editor. Bilal, the kind of rearview mirror data clearly quite grim, but December's numbers starting to indicate a bounce back. The vaccine program has gathered pace since then. And the move in the bond market over the last few weeks, we've seen an almost doubling of yields, kind of 25 basis points. Actually, we're nearly at 60 basis points now, and the pound really rising quite sharply. Is the market pricing in too much optimism here?
No, I don't think so. I think that there's good reason for the optimism. And I think that the important thing to note is that the market's very... So we did have some sort of terrible numbers for Q4 GDP. At the same time, they were slightly better than expectations, which tells you that the economic weakness associated with the second wave in the UK has not been as bad as people thought. And importantly, the UK is very advanced in its vaccine rollout. So it's out the major economies, it's vaccinated more of the population than anyone else. And by our estimates, by early May, around 75% of the UK population will have had its first dose of a vaccine. So that's very, very significant. I think the other thing you mentioned, UK yields picking up over the last few weeks. The Bank of England generally has been on the hawkish side too. And so the combination of the two, I think, is quite powerful to see higher yields. And I think there's a lot more upside, I think, in terms of how much further we can go here.
I'm glad you brought up the Bank of England, Bilal, because the chief economist, Andy Haldane, wrote in the Daily Mail earlier today, granted before the data came out, but said that you could see a year from now annual growth in the double digits. Is negative rates going to remain in the toolbox, never be taken out?
No, that's a good point. I mean, I think it's a very fair point that Haldane made in terms of double-digit UK growth. And I think it might be very unlikely that negative rates will be used in the UK. They are, of course, talking about a tool, but I think in the end, given Haldane's expectations and many other people's expectations of the path of UK growth, it'll be hard to see them needing justification to use negative rates. I think they're much more likely, if they were to do additional action, it would be additional QE in conjunction with additional fiscal stimulus.
Bilal, is COVID masking the negative effects of Brexit?
In some ways it is, but in other ways, because COVID has essentially seen large parts of the economy shut down, it's in some ways allowed the UK to perhaps re-engineer itself more aggressively than it would otherwise be the case. So, I think the critical thing for me from a structural perspective is that what COVID has done is that it's shifted a lot of activities from the physical realm to the digital realm, or from certain locations to remote. And that fluidity and that flexibility, I think, makes it easier in some ways to adapt to a change like Brexit. So on the one hand, it has masked some of the adjustments, but on the other hand, it's actually opened up more possibilities of adjusting to the new world after COVID.
I take your point, Bilal, but we are starting to see some Brexit messiness pop up, Northern Ireland being the latest example. And I wonder, is the optimism around the better vaccine rollout in the UK and the growth that is going to emanate from that, help it catch up, misplaced, given that Brexit is going to remain a kind of structural headwind even once the pandemic is taken care of?
Yeah, no, that's a good point. And I think it's really a question of time horizons. If we're talking about the next 3 to 6 months, the swing variable will surely be the vaccine and removing restrictions. That will have a much, much bigger impact on growth than ongoing structural issues around Brexit. But then as you go a few years out, then some of the Brexit negativities start to pan out. The big question, though, is the other thing that COVID has done is it's opened the door to much more fiscal stimulus than would otherwise be the case. So in some ways, that can also be something that could offset some of the Brexit issues. But you're right, there will be these issues. What's tough to say at this stage is how much of the Brexit issues we're seeing right now are transitional issues. So these are teething issues that we'll see in the next 6 to 12 months around how you do paperwork or what you need to register and not register in order to do transactions. And so that's a one-off. So in that sense, it's hard to determine how much of some of these issues are more permanent in nature.
The UK government says holidays are illegal at the moment, and therefore I want to kind of move that on and talk a little bit about what is happening with Europe, the Eurozone economy in particular. We saw a downgrading of economic expectations for this year by the Commission earlier on this week. I'm wondering how problematic.
That sense, it's hard to determine how much of some of these issues are more permanent in nature.
The UK government says holidays are illegal at the moment, and therefore I want to kind of move that on and talk a little bit about what is happening. Are you heading for a problem later this year in terms of how those economies are going to suffer?
Yes, absolutely. I mean, this is a big challenge for the Eurozone. Now, of course, tourism isn't the only driver of Euro area growth, but certainly it is an important driver for many of the Southern European economies over the summer months. So anything that can lift those restrictions will have a big impact. But so far, what we have seen in the Eurozone is there's been a relatively slow vaccine rollout. So paradoxically, the Euro area has actually done quite poorly on the vaccine side, due to all sorts of internal squabbling kind of issues. So that makes it harder for the tourism industry to recover. So what that means is that the Eurozone will become more reliant on external drivers, other external drivers such as Chinese growth, for example. That will become a bigger driver for Eurozone growth in the coming 3 to 6 months. There is also an issue of how the disruptions to the tourism sector will impact the methodology or the quality of the data we're seeing in the Eurozone, whether it's inflation or otherwise. And so that's also something that could become more of a headache for European policymakers.
Do you think that divergence between what's happening in Europe, the UK, and even the US is fully priced in by the market? I'm looking at a 121.18 on euro dollar. Is that right?
No, that's a good question. I mean, I think what you are seeing is, first of all, there has been a correction lower in the euro over the last, last 6-7 weeks. So there has been some recognition of this divergence. Also, you are seeing the pound generally trading outperforming the euro. So there is that recognition. The challenge here is that there's been a lot of bad news has been priced in terms of the European cycle. And so for the market really has to try to determine how much further to push this bearish Eurozone story. Now, one of the big curveballs here is obviously the increase in US yields. So if that was to pick up pace, then that's probably the factor that could see the euro head lower.
Bilal, what do you make of the markets at the moment? Would you be surprised to see a correction?
Well, I think many people are looking for that correction, and I think the fact that they are, to me, suggests that we're probably going to see more upside, going forward. I do think while there is lots of concern about valuations and frothiness in the market, my sense is that there's large segments of the market that aren't fully invested in stocks. So, for example, when we look at surveys of hedge fund investor positioning, they still appear to be underweight, if anything. And so I think there's probably more scope for a kind of a melt up, so to speak, rather than a correction from here.
And how long do you think that can last? A lot of the finger gets pointed at just all the liquidity that is sloshing about the system, and that doesn't look to change anytime soon. The Fed isn't turning its spigot off in the near future. So how long are we going to see this melt up? What would stop it?
Well, I think at least for the next 3 to 6 months, I think we could continue to see, very aggressive moves higher in equities. And the reason I say that is because you have a combination of very large fiscal stimulus coming from the US. So, of course, we had the December package and now we have the Biden package, and all of that will filter through to the economy in the next 3 to 6 months. Then on top of that, we're at this point where we're having this inflection point in growth, where at the moment, growth is relatively weak because of COVID, but we know we're going to see this big rapid increase in growth in Q2, Q3, or perhaps like Q3, Q4 more like. And so when you're faced with that type of rapid increase in growth, it's very hard for equities to correct lower meaningfully in that environment. Now, as you go towards the end of the year, once you've had this jump up in growth, and at that point, fiscal stimulus is starting to die down, that's a point where equities start to look a lot more vulnerable.
Bilal, there was a chart that was floating around on the terminal a little bit earlier on. It basically showed that only 40% of US companies with a market valuation, that's not the chart I was looking for, but anyway, actually I think that is a chart, with greater than $250 million in market cap. As yields have gone lower, companies with no profitability or kind of delayed profitability have surged. Tech is the obvious case in point. I'm not talking about the FANGs, but some of the other companies. If we start to see yields rising and rising sharply, How do you change the calculation around some of those companies, and how big an effect do you think this will have on broader valuations?
No, that's a very good point. And there is a very sort of strong case to be made that low yields have justified higher valuations. But I think, when you are seeing rising yields, it's also reflecting the fact that growth is going to pick up. So in that context, overall equities should do quite well. I think what high yields do is it tells you what's the mix of equity outperformance. So I think higher yields will have probably the biggest impact on mega cap or mega tech companies such as the Googles, the Alphabets, and so on. So companies that have the growth component but also have the income component, who've done really, really well in a low yield environment. So I think the mega tech companies will struggle when you have higher yields. Now, as for those smaller tech companies that don't really have any sort of profitability and so on, that's less clear whether higher yields will be negative for those, because what those guys are benefiting from is some kind of big technological revolution that's going on, which has come about through COVID. So, biotech companies and software companies and so on, which should benefit in an environment where you have widespread adoption of tech. So that's part of a different theme that is not as linked to higher rates. So I think for me, the biggest implication of higher rates is really more in terms of some of these bigger tech companies starting to underperform relative to other companies.
You brought up biotech. That has been an area that has been targeted by the Reddit day traders that had taken over this market for several weeks now. But another area in which you are seeing that kind of rabid buying is Bitcoin. And we're starting to see more institutional players, companies talking about it, saying they will now accept it. What is your take on Bitcoin? Is $47,000 about right to you?
Well, I mean, I think, a market like that has gone up so much, 47,000, could just be the beginning of a much bigger move higher. I think for me, the critical thing about Bitcoin is that for all the talk of it displacing the dollar and being the new means of payment and all these sorts of things, in reality, it's an investment. And the reason people are buying it is because it goes up a lot. And the critical thing for me has been that early on in the life of Bitcoin, it was really a niche market for computer nerds, you could say, in essence. Now it has institutional acceptance for various different reasons. And there's kind of a bandwagon effect where more and more institutions start to adopt it. So, and we're at the early stages of that, so now increasingly you'll see mainstream organizations start to adopt Bitcoin, and that will lead to much bigger demand for a market with very limited supply. So I think there's much more scope for Bitcoin to go higher from here.
When the correction comes, and it will Bitcoin sell off along with everything else? And when that moment comes, what is going to be protecting my portfolio?
No, that's a very good question. And I do think that when Bitcoin corrects, it'll be at the same time as many other risk markets correcting as well. And I think that in that environment, and in fact, I should add that there is quite a strong correlation between the performance of tech stocks and Bitcoin as well. I mean, I think in that environment, in the end, it's fairly, the conventional safe haven will be bonds. Bonds will start to rally in an environment where everything starts to sell off. You could also see gold, the traditional gold, not digital gold, start to perform well also, because gold has struggled somewhat in recent months because yields have started to pick up. And so in that environment, you'll see gold and bonds start to perform when we do have that correction.
Yeah, is it a digital gold? The perennial question. Thank you so much, Bilal Hafeez, Macro Hive CEO.